So hello traders, welcome back to another video. In this video we're going to talk about a very different topic, something that most traders tend to ignore: fundamental analysis. Often retail traders, we ignore or don't pay as much attention to fundamental analysis, and we focus so much on building knowledge around technical analysis, pattern recognition and price action, but we forget that fundamental analysis is also an important factor in determining where markets eventually go, and especially in the long term, because if you think about how trends develop and how trends end, it's as a result of fundamental factors shifting. So today I'm going to talk about top 5 economic indicators that traders should understand. And it's very easy to know about these things, but very few traders understand them. Now, the first one is interest rates. So what are interest rates? Interest rates are the backbone of every economy in the world. If you think about the bond market is basically determined by the interest rate market, meaning all countries develop based on how much loans you have and how much you charge for loans. If your loans are expensive, most entrepreneurs, most business people will avoid taking the loans. And if people avoid taking the loans, they won't invest money. And if they won't invest money, the country won't grow or opportunities will not exist. So interest rates are very, very important. And if you trade any markets, then I'm sure by now you know about the Federal Reserve, you know about the Bank of England, you know about the Bank of Canada, the People's Bank of China, the Bank of Australia. These are the major central banks that determine the global interest rates in the world. And each trader needs to understand how interest rates move up and down. And more specifically, you need to understand the trends that develop when interest rates move either up or down, and the factors that cause these interest rates to move up or down. But interest rates is one of the things that you should watch every year. If you check like what in most investment banks will talk about, they'll talk about the expectations of what the Federal Reserve is likely to do, the Bank of England is likely to do, the European Central Bank is likely to do. So you need to understand interest rates if you're going to become a trader. So that's factor number 1.
Hey guys, I'm excited to announce that Financial Hub Forex Academy is back into partnership with Paperstone Broker. To get started in your retail trading, click the link below and fund your account.
Now, factor number 2 is unemployment. Okay, the unemployment rate in a country tells us how strong the labor market is, and how strong the labor market is a factor of how well the economy is doing. In an economy where people are doing well, jobs will automatically be created because there's economic growth. So you need to watch for the unemployment rate. You know, how many people in a country are looking for a job and are not able to secure a job. For example, if you look at the US, which is one of the major global economies that most traders will trade in, there's something called non-farm payrolls, or NFP, which is basically the job reports that come out every month. Every first Friday of the month we'll have a jobs report. And that jobs report aims to tell us how strong the economy is doing based on what is happening in the labor market. So you also need to understand unemployment numbers and how unemployment is tied to how well an economy is doing or how poorly an economy is doing. So that's another factor. The third one, which is a little bit tricky, but is still a fundamental factor that you need to watch out for, is something called fiscal policies. And under fiscal policies, we'll have things like taxation, and we'll have other tools that the executive will use to ensure that the economy is running well, or there's too much money in the economy or very little money in the economy. Now, fiscal policies are tools by the government, and you'll hear a bill is being passed in Senate for people to be taxed this much. For example, in Kenya, we recently had people rejecting the finance bill, which was basically a fiscal policy that was proposed by the current government with an intention of trying to tax people more. But most people who were against the finance bill, they complained about it and it had to be stopped. So if you think about the effect of taxation on economies, then you'll understand that Better tax policies will attract businesses, worse tax policies will chase away businesses. Historically, there was the French wealth tax, which took place about 14th, 15th century, somewhere around those times. And the net effect of the French wealth tax was that most people ran away from France because most wealthy people decided to move their wealth to other countries. And the net effect of that was a worse economy rather than a better economy. Because if you have worse tax policies and you chase away investors, people who are bringing in the money into the country, then what you're likely to do is you're likely to cause a country where there are no investments. And if there are no investments, remember, there are no jobs. Again, remember, the role of the government is to just create policies, not to create opportunities. So if the policies put in place from a fiscal perspective are not good, then things are not likely to do well. On the flip side, there have been times when governments have been forced to use tax breaks. Like I remember in 2020 when COVID hit, Uhuru Kenyatta declared a tax break of about 5 or 6% for all employed workers under the government. That meant that people had more income in their pockets, because instead of paying the probably 30% that most people pay will pay around 24, 23%. And this ensured that people had more money to spend. And if people have more money to spend, then the economy is likely to keep on moving forward. Next, I'll look at inflation, which is basically how much value your currency is losing every day. The most basic idea to think about inflation is, if you have 1,000 bob and you walk into a supermarket and I give you a list with a basket of goods to buy, you can get out with a couple of things. You'll probably buy some bread, sugar, and many other things. But then if I give you the same list and I give you the same 1,000 bob, but it's 6 months later and I tell you, walk into the supermarket and buy this, and you're only able to buy a fraction of the things, the money is not enough, then there's a inflation in your country. Moderate inflation is good, because for economic growth to take place, there has to be moderate inflation. But too much inflation is not good, because too much inflation is a sign that there's so much money chasing very few goods. So inflation is also something that most traders will really pay attention to. High inflation is detrimental to the economy and detrimental to the stock market. Low inflation is good for the economy, and so is it for the stock market. So you need to understand how inflation moves up and how inflation moves down. Now, if you think about it, I've covered 5 major things that you need to watch out for. The final one would be GDP, which is the gross domestic product. How much is the output that your country is doing from a gross domestic product. To make it more interesting, you can look at GDP to debt ratio. What is your output relative to how much you owe, and try to understand how these things will affect the different currencies that you're trading. So these are some of the things that you should be watching out for. You should really try to understand. They're not so hard, they're very, very easy. Historically, you can see how different periods played. Like, for example, there was the inflation that was recent, the inflation of the after COVID period. We had inflation in 2021, 2022 across most countries. In Kenya, for example, you had oil prices going as high as 200 and something, fuel prices. We've seen factors like inflation in the 1970s when we had the Israel-Yom Kippur War in US. We've seen high interest rates in the 80s during the time when Paul Volcker was the Federal Reserve Chairman. So we've seen a couple of these things taking place historically. And you will be able to see the net effect that was there in the markets. And I believe as a trader, if you're going to make money and if you're going to be trading for a long time, it is not necessary for you to do things, but it's important for you to understand them. So we've covered all these factors in this book of ours called A Template for Understanding the Forex Market. We've covered about fundamentals, we've talked about those things. You can buy it, try and read it, understand the concepts, and you'll be better off as a trader, because by the end of the day, every single day is a chance to learn and improve yourself as a trader. So with that said, we'll catch up next time. Peace.